But I want to say one other thing that folks tend not to think about, and that is that when the government's paying higher interest rates, households are the net beneficiaries of that because it's interest they receive. But once again, so if the government's spending, $100 billion more in interest costs, that's $100 billion more in income to households.
Hey, it's Rocky. Welcome to Richer Soul. Today's guest is Richard Vague, who shares why debt is good. Imagine it's 12 months from now, and you've achieved your major life goals. How does it feel to be in the best shape of your life? To wake up energized, excited about the day? To have great relationships and friends who support you and propel you forward? How does it feel to have an excess of money, to be able to make the choices you want? To be fearless and open to trying new adventures? Imagine being connected to the universe and it providing everything you desire. It's possible over time, and your past does not dictate your future. The only thing holding you back from this vision is you. It's time to take control of our thoughts and use them to our advantage. Welcome to Richer Soul, where we achieve our dreams and bring balance to health, wealth, relationships, time, and spirituality. If you have not had a chance to listen to episodes 1 through 9, I encourage you to go back and listen to the framework behind Richer Soul and how to create the life of your dreams. You can also find all the show notes for this episode at richersoul.com. Today's quote comes from Henrik Isben. Home life ceases to be free and beautiful as soon as it's founded on borrowing and debt. You know what? I believe that. But today we're going to take a different look at debt with our guest. So here's the question. Is debt good or bad? And I think it depends. I think it depends on if it's personal debt, government debt, or so forth. I still struggle with this, I'll be honest. If you look around, the government's in more debt than it's ever been. There's actually downgrades on its indebtedness. You look at corporate debt through the roof, consumer debt through the roof, education debt through the roof. Like, the question is, how long can this go on, and is it good or bad? What our guest is going to talk about is that government deficit spending, contrary to popular belief, is what creates prosperity. But he also warns there is a darker side that leads to crisis, bailouts, and also it causes greater inequality. And we'll explore why that is and what's going on. We'll look at some history of debt. We'll look at current debt. We'll talk about some possible solutions of ways out and some of the moral hazards of this. And this is the part I don't think people really understand, is the moral hazard and also what we all think of as fairness. What he's going to talk about, though, is debt makes the economy go round, and we'll look at the pros and the cons. Our guest is Richard Vague. His career has spanned fields as varied as banking, energy, and government and the arts. He recently served as Secretary of Banking and Securities for the Commonwealth of PA. He is previously a managing partner at Gabriel Investments, an early-stage venture capital company, co-founder and chairman of CEO of Energy Plus, an electricity and natural gas supplier, co-founder and CEO of 2 banks, and his book is called Paradox of Debt, A New Path to Prosperity Without Crisis, which is what I like. Let's meet him and see what we can learn. Welcome to Richer Soul, Richard Vague. It's great to have you join us today.
It's a privilege to be here. Thank you.
And I am excited to learn from you today. We always like to start at the beginning. What was it like when you were growing up, and how much did your family and school teach you about money?
Not a lot. I had a pretty typical upper middle class upbringing, and, I got an allowance and had a part-time job as a dishwasher, it turned out. And so, I knew enough about money to be able to, buy things, and that's about it. And then when I was in school and college, I ran out of money. I had to pay my own way, and I had to drop out to find a job to pay the rest of the way for school. And the job I inadvertently got was a job at a bank. And that really was the determinant of my career.
So you just kind of fell into it. It wasn't a path you, so to speak, picked.
That's exactly right.
Just out of curiosity, when you joined the bank, did they understand money there?
Banks do understand money, and they do understand credit. And I think they're mainly concerned with your ability to repay. And they certainly do that.
And that is very true. It's funny. And that was a big kind of aha for me. I thought that banks would be happy when I deposited money with them, but they seem to be much happier when I borrow money from them. And that was kind of counterintuitive to me.
That's what a bank exists to do, is to make loans. The deposit side is, it's the loans that make you money. If you were a bank and you had nothing but deposit and no loans, you wouldn't make any money.
And that makes a lot of sense. When you look at it from that standpoint, it makes total sense. It's just, it's funny because, you grow up as a kid and you watch, what was the Christmas movie was it Jimmy Stewart? The bank ran out of money.
It's a Wonderful Life.
The Wonderful Life, right? And so you think the banks want money. They don't want you to take it out, right? They want to hold on to it, but nothing could be further from the truth. So we are here today to talk about your book, and it's called The Paradox of Debt, A New Path to Prosperity Without Crisis. What inspired you to write the book?
Well, the genesis of my interest in macroeconomic theme was the great financial crisis of 2008. And, what had happened there is that the so-called experts, the Federal Reserve and the bevy of economists that are in that industry, were absolutely sanguine in 2007. And a few months later, the world fell apart. And so it led me, and not just me, but a lot of folks, to really question many of the tenets of the economics profession and try to understand what really happened.
What really happened?
Well, we made way too many mortgage loans. And to put a number on it, in 2002, there were about $5 trillion worth of mortgage loans in the U.S. And by 2007, it was 10 trillion. It had doubled in about 4.5 years. And what that meant was there were millions of homes that had been built that were going to sit empty. There were millions of loans that had been made that weren't going to be able to be repaid. There were thousands of banks that had made those loans and not just banks, but other lenders that were not going to get repaid and were therefore going to fail. But it was just way, way too much in one single category of mortgage lending.
And see, I looked at it from a different point, and correct me if I'm seeing it wrong. People were buying properties at inflated prices because they had no skin in the game, one, practically. The properties never cash flowed from day one. People essentially were gambling, hoping that the property would continue to go up, because in 2006 and 2007, the mantra was real estate has never gone down. And yet, I think both of those things blew up. One, that real estate can go down. And two, if your real estate doesn't cash flow, it's really not worth what you thought it was worth. And then it seemed like there was a whole bunch of, let's call it fraud during that time, in the sense of how the properties were being valued by appraisers and all kinds of games being played. Did any of that have a role to play in it, or is it more what you're talking about?
Well, there are two sides to the exact same thing. And one of our earlier book, which is called A Brief History of Doom, we looked at the 43 largest financial crises in the 6 largest countries in the world over the last couple of 100 years. And they've occurred again and again and again, and they're always the same. And what you just described always happen. But they don't start with quite that euphoria. It's gradual and it picks up momentum. So the lenders start lending, and the increase in loans themselves is what caused the value of property to go up. So the lenders start lending, property values go up. That causes people to get excited. That causes more builders to build more homes, and it builds on itself. And as it gains momentum, exactly what you described begins to happen in abundance. Folks see that their neighbors are getting rich by buying homes and selling them, and they say, I want some of that too. And the lenders see that the other lender across the street is getting rich by making lots of loans, and they say, I want to do that too. And before you know it, people are buying homes where they won't cash flow. People are buying homes without proper credentials from a credit standpoint. Fraud starts to creep in and then to flood into the system. And next thing you know, there's, 100,000 homes in Las Vegas that are sitting empty and can't be sold.
So going back 6-7 years prior to that, we had, the tech crash and the stock market crashed. And also we started to see interest rates decline, which makes, of course, buying a property cheaper, because if your interest rate is, we had never seen interest rates as low as they've been. I remember when I bought my house just before 2000, my interest rate was about what it is today, around 8%. And it had come down, I think, or maybe it had just popped up a little bit, but that was kind of more the norm. And all of these things kind of come together and cause this massive problem. So based on what you know of history, what are we noticing today in the markets and the possibilities or the future of a crash? Because I think just this morning or yesterday, somebody else was talking about the fact that even the Fed is saying there's going to be a big crash. They heard someone from the Fed on some other show.
Well, let's be a little specific here and talk about this in terms of real estate, which is because the stock market's going to go up and down. And I'm not going to try to speculate as to what's going to happen there, because that happens a lot and usually it's pretty short-lived. That's not the kind of thing that can bring down an entire economy. And the biggest debt market in the private sector in just about any country is the real estate debt market. And it's primarily around housing and to a lesser extent, commercial real estate. And I would suggest to you that we're just fine right now relative to real estate in the United States. And we're quite a bit, in fact, we're almost the opposite situation we were in 2006. And there's one very telling statistic about that. And it's one of the things I consider to be one of the very most important statistics in assessing an economy. And that's the inventory of unsold homes. In the U.S. right now, there's about 880,000 unsold homes. That's a really low number. In 2006, there were 4 million unsold homes. And if you look over the course of the last 40 or 50 years and try to find kind of a normalized level, we probably should be at about 2 million homes right now. That'd be an appropriate inventory level. So I think what you're going to see, particularly as interest rates ease off a little bit, is you're going to see, continued kind of fundamental strength in the economy because there's so many houses we need to build. But debt levels have been tame in the U.S. around the subject of real estate. The area of the world that's in trouble is China on real estate, but the U.S. is doing okay.
I'll ask a question about China in a moment. I'm assuming then, just from your comments, that the office space debt is not significant enough or a large enough portion that it would truly hurt the economy. Because that's what we're seeing kind of blow up now, is office spaces that are either sitting empty and they can't pay the mortgage, or as their loans get redone and the new rates hit, they can no longer cash flow those properties. And same for, I guess, some retail, some downtowns, all over the place. Is that not, even though it's a problem, is it not a significant issue?
Well, I think you framed it correctly. To put it in perspective, household mortgages right now are over $13 trillion. All commercial rate real estate of all types is only about $5 trillion. So to start with, it's much smaller. And within that, it's just a little over $1 trillion in debt that's associated with office buildings. So it's less than 10% the size of the household real estate problem we had in 2008. So, and even within commercial real estate, we see a lot of, my own estimate is that we're probably going to have, let's call it, $300 to $500 billion worth of problems in the office market. But the banking industry has about $2.5 trillion in capital. Well, it's not enough to really threaten things. I think it's going to be spread out over several years. And I think there's other areas of commercial real estate that are robust. Here in Philadelphia, wet lab space is at a premium. We all know that kind of industrial space for distribution of internet products has been a boom market. So it's going to be tough, but it's not going to be systemic crisis level stuff.
And is there a good tracking of private money? And by private, I don't mean, I mean like hard money lenders. There seems to be a proliferation of, I'll call it peer-to-peer, but it's not really peer-to-peer, but it's more money outside of the banking system that is being lent on a lot of these deals. Is that still significantly small as well?
It's certainly not small to the people that are in those sectors, but relative to the whole economy, it's not large. And yes, private sector debt, particularly real estate debt, is tracked endlessly in the United States, particularly by real estate associations. So, the hard money, the rehabbing type money is been an area of focus, but it's not that big relative to the whole.
Okay. And then the last question on this, you mentioned China. If China, and I know they've had a lot of real estate, they're in boom, I guess. Well, they're in like a boom market, probably similar to 2006 for the United States. Does a contagion there ripple to the United States, or are we relatively isolated because of just how the world is?
I think that if you're not misbehaving yourself, your risk of being impacted by contagion is limited. And I think we saw that in 2008 because we were misbehaving egregiously. Western Europe was as well. In the UK, France, Spain, especially other countries. And so when one of them started to have trouble, all hell broke loose in all of them. But there were big parts of the world that were not impacted. South America, China had very benign lending trends prior to 2008. So they felt it, but it wasn't an existential crisis within their economies. And I think the same will be true. If China should implode, and I don't think that it will, but even if it just has massive problems and doesn't implode, we'll feel it, but not a way that threatens our economy.
Good to hear. So one of the biggest things that you talk about in the book is that money is created through debt, and that this whole process of creating money through debt is not bad, so to speak, and that having these large deficits and this government spending and all of these things actually makes us more prosperous. Did I get that right?
That's exactly right. I think that can be well illustrated. We go into great detail in the book on this, but I think that can be well illustrated by the fact that in the period from 2020 to 2022, that 3-year period, government's debt increased by $6 trillion. And its net worth obviously declined by a number almost that high. In the exact same period, household wealth went up by $31 trillion. And that's for 3 reasons. And by the way, that's not just this 3 period. We can trace, the book shows this, we can trace that phenomenon back decades. The more debt there is, the more wealth there is. And it's simply an empirical fact. And in the case of that period of 20 to 22, it was the result of 2 things. Number one, when the government spends that money, it doesn't disappear. It goes into the bank accounts of households. So if the government spends $6 trillion, that's $6 trillion that went to and now resides in the checking accounts and other investment accounts of households. The second thing that happens, which is equally as important, if not more important, is the flood of new money increases the value of real estate and stocks. In 70%, the vast majority of household net worth is in the form of stocks and real estate. So as the money came out, it pushed up the value of the stock market and the real estate market, and households got 30 trillion wealthier.
So this is what they mean by don't fight the Fed.
I think that's part of it, sure. But, this would be true. There was a century there where the United States didn't have a Fed, and this same phenomenon, it was in place. As money is created primarily by banks, it pushes up asset value.
Is there a time where we hit a limit or it becomes too much? Is there a point where all of this, for lack of a better word, breaks and we end up with an economic crisis?
Well, you have to believe the answer to that is yes at some point. But to put it in perspective, our federal debt level is about 130% of GDP. Japan's is about 250% of GDP. So, we're not at that limit yet, and nor do I think we're necessarily that close to it. But let me approach that. And obviously there's a limit to private debt because, you get, and I think the more private debt you have, the slower the economy grows because folks are just burdened down with too much debt. But let me throw one other wrinkle into it. And that is, we just said 70% of household wealth is stocks and real estate. But it turns out the top 10% of households own 65% of all the stocks and real estate in the country. And the bottom 60%, that's 60%, only own 14% of the stocks and real estate. So if increased debt pushes up asset values, by definition, it's going to increase inequality. And we've seen a dramatic increase in inequality since World War II in the country.
So I have a question for you. How much of that is behavior based? And what I mean by that is my local grocery store has this vending machine that you can put $20 in for a lottery ticket, right? If I read the book, The Millionaire Next Door, the guy with that or the gal with that mindset isn't putting the 20 into the lottery machine. They're putting the 20 into a stock or real estate. So their behavior becomes that way. If the people at the lower end change their behaviors, and I don't know how much excess cash, it just seems like, and especially during the COVID money, money kind of flowing everywhere, they had more money than ever. It didn't seem like they held on to it. It seemed like it all got spent. And I don't know if it was wisely spent. And I don't know if any of your work looks at how much of this is behavioral in the way that they use their money.
Well, you're talking about one of the deeper and most important questions there is, which is, how can we change that? Why is it the way that it is, and so forth? And we certainly don't try to get into that in the book. It would have taken us 3 or 4 more volumes, I think, to even begin to address that. So what I would say is, first and foremost, this is empirical. This is, in fact, what is happening. So, it tees up your question, which is, why does it happen? And that's a tough question. But part of the answer is what you said. Most folks don't have enough excess cash to cover a single, let's call it $400 emergency. So most folks pretty much spend everything they make, and they do that continually. And that's just the facts. That's just the facts of the matter. And wage growth has been fairly flat for about 4 decades now. So we're not seeing folks move into a position where they have the earnings where they can start tucking away a meaningful amount of things.
I'm wondering, and I'm not the one who looks at this data, I'm wondering how much people go through up and down into different income levels, so to speak, because I have heard that throughout life, people aren't always consistently in a wage group, that there are times where it does go up and down dramatically. But at the same point, if I look at society, more and more 6-figure earners don't have the $400 either.
Well, one of the great things about this country is we are the most mobile country in the world. And the chances of somebody who's in the bottom 60% making that leap to the top 10% is greater in the United States than anywhere. It's still, even with that fact, it's still not that prevalent. Okay. It's still true that the primary determinant of where you're going to end up is where you started.
Our listeners are a little different, but I know it's a very teeny percentage. And I only say that because we've had a lot of very successful people on, and we ask where they started. And for many of them, they started lower middle class or, at the low end of the scale. And it was because of that, and within them a desire to change their future, that they found a little bit of grit. So maybe I know I'm finding a subset of people who are different.
Well, thank goodness for you and your listener. And frankly, that's part of what makes this country the great country it is. And I have to tell you, I feel like I fit in that as well. I came from modest circumstances, and I had opportunities that folks in other places wouldn't have. And I was fortunate and got there. But so absolutely, there's wonderful story after wonderful story of folks that have grit, that, put their nose to the grindstone and do exceptionally well. It is still nevertheless true that the primary determinant of where you end up is where you start.
And I don't disagree with that. We're trying to always figure out what is that spark that changes it, and how do you do it? Because we see the second half of the spark. 2 to 3 generations later, it goes full circle. Yep. And that's fine. How much was COVID and now the war that's happening with Russia, how much of all of that has an effect on money and growth and I mean, essentially massive amounts of debt too, with regards to all that spending?
Well, you just named the 2 factors that fed into the recent bout of inflation we had. So, a lot of folks think, almost reflexively that it's, we're printing money and that causes inflation, but there's actually very little correlation between those things. And what we really brought our inflation this go round was COVID just kept workers at home. So supplies were decimated all up and down the supply chains. And, that took inflation from, like 2% to like 6 or 7%. And then lo and behold, wouldn't you know it, Russia and Ukraine find themselves in a war. And between the two of them, They're among the world's leaders in supplying oil, natural gas, wheat, and a lot of other things. So that took inflation in the U.S. from, that 6-7% range to 9%. But now it's back down to 3%, and it's been back down since last July. We have 12 months of fairly benign inflation at this point in time, and it needs to get down a little further, and that may be a little harder. But COVID and the war were the central culprits in that.
So even though inflation's at 3%, the Fed rate is considerably higher. The average person, if they have cash, can put it in a CD in a bank and get more, which means that the government's got to pay a lot of high interest on the debt that they have, and they do have a ton of it. Have we ever been in a situation like this with a government with such excessive debts and this inflation environment and the pressure that's putting on how much of the federal budget has to go to debt payments? And I guess they just, I know print more money isn't the right word, but more excessive spending. Do we get into a spiral, or is this just, it's okay? Because I know for a lot of people, this makes their head spin. It does mine.
Well, and let me count on the interest rate first and foremost. Our inflation came back down to earth last July, and that was at a point when interest rates were 2% rather than the 5.25% they are now. So I'm one of those that does not believe that the Fed had to put interest rates up to where they are now. Inflation began to behave without it. I think we're creating a lot of unnecessary pain with these high interest rates. I also don't think these higher interest rates are sustainable. I think that over the next year or two, they're going to come back down. Now, I may be in the minority on that as well, but I think that's true for a variety of reasons. One is that it's hurting the middle and lower classes so much. And, secondly, it's this issue in the federal government budget that you alluded to. But I want to say one other thing that folks tend not to think about, and that is that when the government's paying higher interest rates, households are the net beneficiaries of that because it's interest they receive. But once again, so if the government's spending, $100 billion more in interest costs, that's $100 billion more in income to household.
I think that's a concept that is hard to comprehend.
But let me quickly append that comment by saying almost all of that is held by the top 10%. So the bottom 90% of households are net debtor. In other words, between their mortgage and whatever else they have far more debt than financial assets. The top 10% has far more financial assets than debt. And so, that benefit goes to households, but it tends to go to the wealthiest household. But in an economy, and let me just throw one more sorry to interrupt, but income equals expense. Income has to equal expense. So if the government has an expense, it's income to somebody. And in this case, the majority of government debt is owned by households, whether directly or through pension funds or investment funds.
Today's episode is sponsored by Profit Answer Man Podcast. Did you know that most small business owners hate looking at their financials? It's one reason they may struggle with business success. The Profit Answer Man podcast helps them ensure they are profitable and can pay their employees and weather the storms we all have to face. It's built on the Profit First methodology of pay yourself first. The Profit Answer Man podcast is a must listen to for every small business owner and anyone who wants to help them survive and thrive. Check it out on your favorite listening platform. And so this creates this paradox in my mind because, and we're going to get to this in a little bit and we'll talk more about it, but it almost seems like in an inflationary time, having debt is a positive. And sometimes I think I should have gone into more debt before the inflation hit so that I could kind of ride that wave of lower payments. But I guess I'm just looking at one part of the piece of the equation and I'm missing some of the other parts which are driving the economy. I'm looking at myself as a solo person, not as a part of this entire system and what's going on.
Well, I'd go back to what I said, which is income equals expense. So if higher interest rates are an expense to the government or anyone else, by definition, it is also income. So net, it's a zero. So there are winners and losers in equal proportion here. So now I can remember, I was a kid in the 70s, and I remember folks saying at that time, particularly real estate folks saying, borrow everything you can borrow to buy real estate because real estate is appreciating more than the penalty of that interest rate. Since the interest rate is tax deductible, blah, blah, blah. And yeah, that can be true if your timing's perfect. But generally speaking, the middle class tends to be hurt by higher interest rates.
And I remember 18% CDs. And back then, the banks weren't the one handing out the mortgages. The people selling the houses were taking seller notes and with balloons to cover people because that's where life kind of got.
And savings loans were played.
Things do repeat. One of the things you talk about is the debt jubilee, which also goes back to, should I borrow like crazy, right? Because if you're going to forgive all the money, why not? I mean, and that is the big fight that came up recently with the college loans and also just moral hazard. And in like the whole American way was always about if you borrow money, you repay it.
Damn it.
I'd love to hear your thoughts in this area.
Well, I start with an observation that I think is one of the most important observations you can make about macroeconomics. And that is that debt always grows faster than the economy. So in the U.S. in 1980, total debt, which is the sum of the government's debt plus private sector debt, business and household debt, was 125% of GDP. Today, it's 260% of GDP. It's double in my lifetime. And it's not just in the United States, it's in every developed economy. We study the top 7 economies of the world very carefully. That's China, Japan, India, Germany, France, the UK, and the United States. That statement is true of every one of those economies. In Japan, total debt has gone from 125% to 400% of GDP in that same time frame. In China, it's caught up to, it's gone from basically nothing in 1980 to the same level as the United States today. So debt always increases. And in the book, we get into why that's true. But debt increasing is not a flaw. It's the way the system is built in the first place. So if that's what is happening, then it's all, I almost come at it as an engineer work. If I had an engine and the temperature of that engine was always rising, well, I would put in an exhaust system or a cooling system or something to deal with that. There's no such apparatus in the world economy. And as I was going through this, and then, I began exploring, and I've had books that, get into this in great detail, there is no deleveraging. Politicians and economists talk frequently about, we'll just outgrow this problem. Never happens. Never happens. And the reason it doesn't happen is you can't outgrow debt because it takes debt to grow. So at any rate, one of the things I stumbled across in this was that debt amnesty or debt jubilee was something that recurred frequently in ancient civilization. Debt has been there since the very first civilization. It's not a recent phenomenon. In Assyria and Babylon and Egypt and ancient China, rulers would come in at a point in time where this debt had accumulated. And forget it. Hammurabi, 4 times in his, I think, 50-year reign, enacted a debt jubilee. It was such an important thing that it actually got calendarized in the ancient Israel society. That's where the term jubilee comes from. It was done automatically after 7 periods of 7 years. And, obviously we're not doing that today. The debt situation's much more complicated. But it was fascinating to me to see that this is not a new problem in civilization. It has been there since the beginning. So my book, I'll say one other thing and then I'll shut up. But, in today's society, forgetting debt is very problematic for all sorts of reasons, including the issue of fairness. The student debt problem that we talked about, one of the most pungent critiques of it was, what if, I'm 25 years old and you're 25 years old and we both took out a $50,000 loan to get through college, and I took 2 part-time jobs and never went on vacation, and I've paid my debt down largely, and you've been profligate and partied and always paid the minimum on your loan, and it's still outstanding. And then somebody comes along and forgives you your debt when I've paid mine down. How is that fair? And of course, the answer is it's not fair. So, even within the context of fairness, we need to be thinking about ways to make debt more manageable. So, for example, in student loans, I offer the idea that community service, extensive community service over a long period of time would be a way to get early relief of your debt. So, may not be the perfect idea, but it's something I wanted to put on the table.
So I was really struggling with this part of the book. And I was also struggling because, and you talk about this, the major reasons I think of bankruptcy, which is job loss, medical, family breakup, and so forth. When I look at inflation numbers for 2 categories, medical and college, the inflation numbers compared to everything else are off the charts, and they are both very similar. And my thought, it's a popular thought, it could be a very wrong thought, is that one of the reasons inflation has skyrocketed in both of those areas is because, as you mentioned, when the government hands out money, it essentially is creating wealth, and it seems to have created a lot of wealth in college and medical pocketbooks. And if you look around at a college today or a hospital today, compared to what they used to look like 30 years ago, they used to be like the Howard Johnsons, and now they're like the Ritz-Carlton. They have spent a crap ton of money inappropriately. I came out of the medical side. I know that costs and just all of that is absurdity. And it's almost like, why don't we just go back to the colleges and say, your whole job was to teach these people how to get a job and make money and be productive in society. You failed. Let's take money from you and forgive the debt. Let's hold them responsible instead of society in general. And that is hard to do.
Well, there's a lot of truth in what you say. The student debt is a great example of that, because you go back just a little bit over 10 years ago when total student debt outstanding was $250 billion, and today it's 1.8 trillion. And that there's 2 components to that. One of them is that along came for-profit colleges, what some folks might pejoratively call diploma mills, these colleges that were taking advantage of student loan availability to get you to borrow, get a degree from their college, charge you a lot, and you ended up with a lot of debt and a degree that wasn't worth much of anything. That was a big component of the run-up, and that's since been remedied, by the way. And the other part of it is kind of what you mentioned, that colleges have become extraordinary. The very best of them have become extraordinary institutions with finest facilities and this and that and the other. But the consequence is tuition is, extremely high. It costs $80,000, $90,000 a year to go to some of these really good schools. And so my book certainly has peaked out reduce costs in education or in healthcare, but you are absolutely correct in saying that's a big part of the problem. Forgetting debt and the issues associated with debt, we just need to address the costs in key areas in a much more assertive way.
If they're going to do a debt forgiveness and they want it to be acceptable, is for them to say, going forward, the government's no longer going to guarantee college loans. They'll just hand out grants for people who make below X and do some community service. So going forward, there's a path, but the money's only available to a segment of people that probably deserve it. And at the same point, looking at the medical side and saying, you know what, we're not just going to pay whatever you bill us. We're going to negotiate just like everybody else does. And y'all are going to have to compete for the healthcare dollar, so to speak, because the majority of healthcare dollars are spent in the last year or two of life. And they're spent without regard, because at the end of the day, the people who it's mostly spent on have no skin in the game. Because if you're part of Medicare and especially Medicare and Medicaid, bring it all on. I don't have to pay anything, right? And so taking away the incentives of what drive it all so that we can at least get back to some semblance of reality.
Again, I think there's a lot of validity in what you say. And in relative to college education, I would infinitely prefer that the government gave grant rather than kind of hurting folks into debt. I see that as a magnificent equation. And we basically had that in the GI Bill. We were paying for folks, after World War II, we were paying for folks' college education, and that helped create one of the golden eras of economic growth in the country. I think healthcare is much more complicated. I think one of the issues is we're just older. The average age of the country in 1980 was 30 years old. Today it's 39 years old. And, the older we are as a country, the higher percentage of our national expense is going to be healthcare. I think, there's a lot of things going on that are good on healthcare expenses and a lot of things that are bad. One of the things that's happened in the last, I would say, 5, 6, 7 years is for the first time ever, the government is reimbursing based on results rather than instances. So in the past, and I saw this firsthand, a hospital got paid more if you came back for the same malady multiple times because you were getting paid the same amount every time. And they changed that and are continuing to change that, where they're going to pay you one time a specific amount for something, so that the premium within hospitals is in the middle of changing towards getting the person well on their first visit and not so. But, the third thing that I would mention in healthcare, and it's just a fact, is we're innovating in profound way, genetic engineering and the like, and we have the ability to cure diseases we never cured in the past. But the cost of these new treatments is, in many cases, exorbitant. And so we've got this really, incredibly difficult decision to make, which is who are we willing to spend the money? We now have cures we never had in the past. They're very expensive. Do we withhold them? We're going to go back to their earlier regime of costs, or do we spend them and escalate our bills? And who makes that decision?
never easy. I like having everyone have some skin in the game. Now, granted, if you've got $1 million, we're not going to treat you like someone with $400 in the bank account. It's creating some sort of equality, but also creating a bit more of skin in the game. Because even when back in the day, when the VA started charging $1 for prescriptions, the amount of prescription refills fell through the floor because of a single dollar skin in the game for that. You mentioned the population's getting older. As our populations get older, and I know China's population has extremely aged compared to its young population, the reality is those people are going to die off. And that leads to population declines. How does all of that affect this debt and monetary system and so forth? Does it mean that there are bigger burdens for us to all carry that are still alive?
I think the global demographic challenge is one of the biggest problems we have, and it's one of the least appreciated problems we have. There are countries, China is now one of them, where the population is actually declining. But that's also happening in Russia. Now they're not doing themselves any favors by going to war, but it's happening in Germany. It's happening, I believe, in Spain. It's not happening in the U.S., but our growth isn't nearly as robust as it was. If you have a lot of debt outstanding and a declining population, that by definition means folks that are left have a bigger challenge, a bigger debt challenge. And I think that's a very highly underappreciated phenomenon.
And I don't disagree. And I think this is where I have a problem with government solutions. The biggest thing we talk about on the podcast is the idea of harmony, right? Everything has to work together. And too often we make decisions that cause disharmony. For example, we started handing out money so people could go to college because that was the good thing to do. And it created essentially a monster. We created a monster in healthcare, handing out lots of money so people could buy homes back in the early 2000s created a monster. And unless you look at all the pieces together, how they fit, how they work, and how they roll, I think we end up with unintended consequences.
Well, dramatic unintended consequences, and we continually face dramatic unintended consequences. But, at the same time, we have challenges. We're not going to get everything perfect. And it's, a lot of it's an issue of trying things, but being willing to change direction if you need to.
So I'd love for you to kind of wrap up your work, the book, your thoughts, and kind of bring us all kind of to a conclusion. Your book is definitely looking at debt very differently. As people finish listening, what do you want them to walk away with thought-wise of how to look at all of this stuff that we've talked about today?
Well, we're not saying we've got a magic elixir. Read the book and you will know how to do it. Instead, we are saying there's something you need to know about debt to be better informed as a policymaker, as a voter, citizen, and for your own personal financial decision. That the way the economics profession has approached debt has, largely overlooked, neglected the proper consideration of debt. For example, the Federal Reserve's forecasting model for our economy, the most important, forecasting model there is, doesn't even include consideration of debt at all. Called the DSGE model. And that's the reason they miss calling the '08 crisis. Is you don't have debt in your model, how are you going to know about a debt problem? So what we're trying to do is bring back a comprehensive understanding of national and global debt. Our book looks at assets and it looks at debt as an asset and a liability. So I think our takeaway is we want listeners that really care about macroeconomics to read the book so they'll have a more comprehensive understanding of something we think is the most important factor, certainly one of the most important factors. But then within that, we kind of have three takeaways. One of them is that debt always grows faster than the economy. And that's something that was shocking to me when I discovered it, and I think is important to understand. The second thing is that debt creates wealth. All money is created by debt. Debt creates wealth. And the third thing is that while it's creating wealth, it's creating a lot of trouble at the same time. Much more significant inequality, occasional major financial crises, a burdening of the middle class and the like. We call the book A Paradox of Debt for a reason. It is the creator and the destroyer. So our takeaway is not some magic elixir. Our takeaway is folks that are fundamentally better informed about the economy.
And I think you definitely did bring up a lot of good questions. It did open my eyes to how debt is beneficial. I still am trying to wrap my head around parts of it. I can understand parts of it because, in a practical application, I've always said the easiest way to become a millionaire is to go borrow $1 million, buy a building, pay off the mortgage. Then you're a millionaire. So in that case, debt was good, but you had to use it responsibly. And I think that's where I have very little trust of the government to do things responsibly because politicians just don't tend to do that. And we'll leave it at that.
Well, there's no question that the government has taken us down the wrong path on many occasions. But the government's taken us on down the right path on many occasions too. One of my books is a business history of the United States, and we talk about all the things that the Transcontinental Railway, the internet, the canal system, some of the medical breakthrough. So, you get both. And the other thing I would tell you is, as much as we need to be skeptical about the government, we need to be equally skeptical about the private sector. Because the private sector is what brought us the '08 crisis. The private sector has brought, I think both the public and private sector are capable of much good and much harm. And I think we just need to be well informed.
And I think I agree with you on that. It's time to learn the secrets of life. What's your secret to living an abundant life?
Well, I think one of the keys is good old-fashioned persistence. I think, someone once said, failure is not getting knocked down. It's not the getting knocked down part, it's the staying down. So, the key to me is getting back up and taking that next step.
And that's very true. We talk about all the skills that aren't taught in school. I don't know if getting back up is a skill that's taught in school. What did you learn later in life that you wish you would have learned sooner?
To listen.
Interesting. God did give us, right? One mouth, two ears. If you were to give an 18-year-old one specific piece of wisdom, what would it be?
Well, I think it'd be the two things we just made. I would certainly tell that to my own 18-year-old self if I could go back and visit him. I was one of the, I guess there's a lot of folks like that. I was one of these folks that thought I knew it all and could do it all and nothing was ever going to go wrong. And, and my favorite story, on listening is I was, a 30-something CEO and, we were doing well and I was full of myself. And I went to, an executive coach and I was complaining. I said, I will come into my management team with these great ideas and nobody will say a word. I won't get any feedback. And she looked at me and she said, you're getting complete feedback. Yeah. And, of course they were telling me no in a very polite way. And, one of the roles she gave me that I think I succeeded in implementing over time was when I bring forward an idea, when I'm talking to folks, I wait and hear everybody else out before I put forward my own idea. And that's been, and by the way, when you do that, you often find somebody else has a better idea before you get to try yours out. It saves you a lot of time and trouble.
We call that the gift of going second.
I love that phrase.
If people would like to learn more about the book and what you do and everything that we've talked about, what's the best way for them to do that?
Well, it's The Paradox of Debt. So you can go to paradoxofdebt.com or Amazon or Barnes & Noble.
Perfect. And we'll put that in the show notes. Thank you so much for joining us today.
Well, you certainly did a spectacular job, and it was an honor to be here.
Has your view of debt changed? I'll be honest, I struggle with this a lot. I understand the concept that debt actually helps our economy grow. I'm wondering, though, how we could make the economy grow without massive debt. So far, it hasn't seemed to be a problem. Of course, that's the way it always is until it is a problem. And I think throughout the world, every single country has the same problems, and COVID made it so much worse. So I don't know what the future looks like, but I know, at least from a personal standpoint and from a business standpoint, having a good balance sheet, which means you have a lot more assets than debt, has worked in the past until you end up in a situation of hyperinflation, which excessive debt can do. So at the end of the day, I'm still unsure of how to play this game, what to do, and so forth. In the meantime, I just continue to build assets. I will say this, the one thing that I have changed recently when we talk to people is if you have low interest debt, it does not make sense to pay it off when you can get more interest just putting money in the bank. That said, we don't spend the extra money, okay? We keep it and hold it and let money grow at 5 and 6 or 7% while you pay down debt at 2 or 3%. And it's that spread that gives you the ability to stay ahead a little bit of inflation and build more wealth. But I think the bigger issue, and the one that happens kind of like a frog getting boiled in water, is the value of our money continues to depreciate. Just ask yourself, what does a dollar buy today? What did a dollar buy 20 years ago? What did a dollar buy 100 years ago? How much was a house 100 years ago? Back in the 20s. I mean, we're talking pennies compared to today. 100 times, that means the money we have, even though we have more, is worth less. I think that's another big problem. You got to figure it out for yourself, see what works for you, and at the end of the day, we can't take it with us. Hey, do you know somebody who would be interested in today's conversation? Would you do me a favor and share this episode of Richer Soul with them? I'd appreciate it. If you like posting these things on social media, that would be awesome. Go ahead and tag me. Next week, we've got land banking with Brad Warren. Now, here's the thing. There's only so much land in the world. They can't create more like they do with debt. And it is a way to maybe build wealth and keep up with inflation. Check it out. I know you'll like it. Have a wonderful and abundant week. Thank you for listening.